Welcome to another Founder Wisdom Pod. We have Castleigh Johnson with us. He's a founder at MyHomePathway. So he's a CEO, a board member. He's backed by Google and AWS, Bank of America Labs. First time I hear about that one. We're going to discuss this one. He's the next Goldman, EY, and bank regulator, and a bank risk exec. So a great profile here. He's in the New York area. I'm in Oaxaca, Mexico. And this podcast is presented to you by BookWriteGPT.com. If you want to take your LinkedIn posts, convert them into a beautiful book with AI that you can publish on Kindle, go to BookWriteGPT.com. You have a free credit on me. Castleigh, welcome to the podcast. Welcome and tell us a bit more about yourself, what you're up to nowadays.
Charles, thank you. Nice to meet everyone. Castleigh Johnson, the CEO and founder of MyHomePathway. We're a fintech platform in the mortgage space geared towards helping consumers that have traditionally higher risk profiles or get rejected for mortgage applications become the technology platform that they can work with to improve their risk profiles, to get them back to mortgage approval and get into home ownership. At the same time, we also create a sales pipeline and sales channels for lenders and realtors. So when they work with consumers that they can't typically meet standards, they can send them to us. We can rehab their profiles and also send them back to those organizations or those individuals. So again, we create a sales pipeline as well as we create access to capital for consumers. So we're sitting in the middle of a lot of different opportunities for both sides.
And why go from comfortable 300K year salary to launching your own company?
Oh, wow. That's the $800,000 question, or the $8 million question. There's a pretty big problem when it comes to home ownership and access to capital, especially for underserved communities, immigrants, younger millennials. And a lot of folks have tried to solve this problem in a very bespoke way, either through nonprofits or financial literacy, which is just PDFs. And that hasn't moved the needle. So, for example, like Black home ownership, for example, in this country has stayed literally the same from 1968 to 2025. We've had the same 30-point gap for a very long time. And with a lot of good intentions, regulators, banks, the problem still hasn't been solved. So we have to build a business as usual product and process that is going to actually move the needle, and it's helping both consumers and lenders.
Right. And if we start from 2008, I even believe that banks were sort of preying on these families, these low-income families, or even colored people that wanted like loans for their houses, and they would literally
it started before 2008. Yeah, so it was like 2005 to 2007 actually was a really big run-up. So a lot of that stuff was called predatory lending. So ninja loans, no docs, no nothing loans they literally came up with a name for this shit. I'm sorry. But
that was insane, man. Like when that happened.
But it also was built on the premise of originate to distribute. That was actually the former Fed chair, Alan Greenspan, that came up with this thing that if you spread risk around the entire system, that it will make it easier for access for everybody. The problem with that was risk just reconcentrates in buckets where people don't understand that risk. And so when things get a little bit dicey, and then you also incentivize people to do some of the shady stuff that you mentioned. Like if they're like, oh, risk gets spread around, nobody really cares. I'll just create CDO specials and CLO specials and CMO specials. And nobody knows where the actual cash flow is. It's like 4 levels away from the actual mortgage payment. And so at that point, the market just got a little bit too happy and nobody was regulating it. It was like in a perfect sweet spot. And that's what you end up with. They're like, oh, nobody really cares until something happens.
Right. And the Big Short with Steve Carroll, still remember like all these bros, right? Like the mortgage bros with the 7 Series BMW just selling one of these after the other. And then there were the CDO finance bros and all that. You've sort of been part of that industry for a while. How is that like seeing that firsthand?
Yeah, I mean, mortgage-backed securities, right? So mortgage-backed security is always a big portion, and then the insurance piece of that to say, hey, we insure the risk of any delinquencies in a pool, right? When you collateralize all these obligations. Part of the problem is when you start putting a bunch of really dicey and risky assets on top of good mortgages, there's only so much really bad mortgages you can put on top of good mortgages. But when you start spreading that out and be like, let's put a whole lot of really shady mortgages, we call them, on top of good mortgages, at some point it just takes a little bit of downturn or some challenges in the market, and then it explodes.
Right.
So yeah.
And we know the effects of that on a larger scale, right? With banks having fallout and the world economies falling apart. But what's the effect that it has on communities and let's say Black communities? What's the effect on these
wealth.
folks?
Yeah, tons of lost wealth. So you're talking hundreds of billions of dollars of lost wealth. And so you see foreclosures, and foreclosures impact existing home values or home values that, again, drive down equity in some of these communities. And so what you want is sustainable home ownership, right? So there's origination, like just get somebody into a home. And then there's the sustainable side of that, where not only are you just getting them in, they got to stay there for 5 or 10 years. That's how you really build wealth. That's how you build stable communities. And that's part of where people forgot that part back in 2005 and 6. They're like, oh, we just throw anybody into a home. And if they get there, they stay. No, if they default in 12 months or 13 months, it's going to crush, again, the existing property values of the folks around them. And then it's also going to make just loans harder for everybody, right? The price of loans go up because now we have increased delinquencies, write-offs, et cetera. So it's a very delicate balance that the entire market needs to maintain. But in that case, it was a very different time, right? It was like the wild, wild west in mortgages. Now we're nowhere near that type of environment. Now we actually have very significant housing shortage. So we are probably 5 to 6 million homes short for new construction in America. And so that's another area that we have to address, is like, how do we incentivize affordable home development? Because now you can just say a developer like, hey, they just want to build $800,000 $1 million homes, but the average person's salary can't really reach to $1 million home. So you got to kind of incentivize now more developers to build $150,000, $250,000 homes. Those used to be called starter homes back in the day. Like your first, 1,100 square foot home, like a little Cape Cod, 3 bedrooms, 1 bathroom type stuff. That's, again, a lot of that needs to be built in America again, where You're not looking at your dream home, like that 4,000 square foot, $800,000 house. You need a starter one, something that, average people can afford.
Right. And we have that crisis in Canada as well. Here in Mexico, I don't believe we have that. It's a whole set of other problems here. But how would you build these starter house at scale? Would it be government incentivized? Like how would you take that one?
I mean, there's going to have to be some federal and state incentives to really move the needle, and some tax incentives, right? So it's going to be, it's not like a one size fits all part answer, but it also is going to require additional funding from government agencies, state agencies. Because you think about how the suburbs were built back in the 1940s after World War II, there's a lot of government subsidies that went into that. Even the highways to be built, all these infrastructure programs, all of that was government subsidized. Now we don't have necessarily the same set of issues, but we still are very short in terms of housing supply. So we do have to think a little bit outside the box. In some places there's land, so you really incentivize some new first-time development contracts for those and create some tax incentives. For some cities, it's like renovating commercial real estate properties that are vacant. So there's different like toolboxes that we can step into for different places in the country. But at the end of the day, we know we're short, and the number is not getting smaller because there's less new construction overall. But then there's almost very limited affordable new construction.
And weren't Compton such a project, and it ended up the way it did? And weren't there a bunch of these projects as well in NYC? And they ended up like being dangerous hoods where you can't walk without being shot at?
Those weren't necessarily homes, they were apartments. So they were built as apartments for rentals, not necessarily for home ownership. So again, there's a little bit of a difference there. So yes, there is subsidized rental apartments being built, but even condos, like switching it to condos would be a pretty good opportunity still in New York. But if you also look at technically, violence is when there's low economic opportunity. Really not necessarily where it is, because there's violence in any other country and lower economic opportunity places in those areas. So those pieces of violence are literally there for lower economic opportunity. Now you have these things called opportunity zones in the US that don't really help the community as much as they should. But that's, I think, the focus that we need to have is like, how do we create better jobs? How do we create affordable supply within the communities? And you'll see crime rates come down. Because when people own a part of where they live, they act very differently.
So in your opinion, it all stems from low economic circumstances and not having a way out?
A lot of it. A lot of that, the challenges within a lot of those communities. But you also see that real estate especially is a very interesting cycle in play. And so I'll use a super simple example: Brooklyn, Harlem, different parts of New York. And that happens all over in different parts of the country. But where Barclays, where the Nets play right now in basketball, that area used to be not so great. So again, low property values, a bunch of developers can come and buy stuff very low, get city sign-offs and tax incentives to then rehab that area and make it one of the most, best areas in Brooklyn, right? That same low real estate play, regentrification, as they want to call it, gentrification, happens all the day.
Yeah, that was my next question. Isn't that like the negative connotation of gentrification? I don't really believe in gentrification on my end, but what are your thoughts on that?
I mean, so gentrification was when you replace everybody that was in the community prior to. The problem is you shouldn't replace everybody. You should give them also an opportunity to participate in the better upside when, if they've been there for a while and they have the opportunity to participate, give them an opportunity to participate. Gentrification has a bad rap because it's saying, hey, here's a low income, maybe a lot of times minority neighborhood that has high crime rate or whatever, right? Just low real estate value. We're going to buy up a bunch of stuff and kick all these people out and then bring a bunch of other people in with a little bit higher income, but they weren't there for the last 50 years, right? That's where the bad rap comes.
I think to your point, the stem problem is also owning the house. If they would own the house, the value would go up. But a bunch of these people rent, and if they rent, the rent goes from $2,000 to $3,500. Yeah,
or $5,000. It can skyrocket, right? As the value.
Then you need to move.
Then you need to move if you don't own it. But here's the other part: a lot of them, again, are rental places that the developer can just go to the landlord and buy 15 buildings. And that's 2,000 people gone, right?
Holy shit, yeah.
People don't think about the math, right?
So they're literally kicked out from 1 month to the next.
Sometimes it takes a little longer. It's not really just a month, but
like it's Trump style, right?
Well, that's your boy style. But it is like, hey, we're going to get all of these folks that were there in the community. They're not going to have an opportunity to participate, again, because if they're not owners, they don't really get a chance to participate, right? It's the owners who are the landlords that own the buildings that sold to developers. They participate. But That's where, again, the challenge becomes where you need to create more equitable opportunities for those folks that were there to still participate in some of the upside. And so a lot of the developments now should have some affordable home ownership bills attached to them. So the folks that were there can like, hey, I can afford a $350,000, $400,000 house in, say, New York, because it's a little more expensive. Versus when you rebuild that, it's 1.2 or 1.3 million. Those people can't afford 1.3 million. They can afford 350 or 400. So there's got to be where we think through making sure that there's enough affordable supply to folks that were there, even while you're building, to make the grand hotels, the entertainment vicinities, and nobody wants to stop progress, right? That's not what we're doing. But we want to make progress as equitable as possible for everyone that's there. The businesses, the community, the developers, right? The city. And so we just have to think more holistically about this stuff.
Right. And that's where you come in with My Home Pathway. You vet these profiles, make sure they don't default, make sure they make sense, and loan out money where other big banks wouldn't loan money.
Even before that, there's some people that say, for example, Charles, there's 1 million people that don't meet a certain underwriting standard today. And so for a lot of them, it's not that they're bad people. They just don't understand what it takes, right? So how do you help them with technology become better, smarter consumers? And that's really what we bring to the table. So we're going to take bunch of people that are considered subprime, high risk, and say, hey, let's help you understand where you are, and not just understand it. Let's actually build your profile. Let's not do, gamification and credit repair and a bunch of dispute letters. How do I help Charles build a really solid risk profile so that lender A loves Charles? Like right now, you're down here, lender A doesn't love you, right? If I bring you up to here, A, B, and C will love you. Because then now Charles has opportunities, he has options. And so that's where you kind of trade a two-way value to say, hey, these institutions, these lenders have their own risk standards that they need to maintain, or the regulators will come after them, right? They'll have higher delinquencies, et cetera, and they'll lose money. But if we can say, hey, and we're asking them make loans to consumers, that's part of their job, but they don't want to make loans to people that they consider too risky. So the folks that are too risky, which is a lot of U.S. citizens, how do we help them go from here to here? Right. And so now everybody has better opportunities and options.
And that's a great starting point, great 0 to 1 point, and which can have almost instant product market fit. Would you like to change the system from the root cause eventually? For example, the credit system, isn't that a bit dumb? Shouldn't it be reshaped?
So, yes.
Credit score, I mean.
Yes. The answer to your question is yes. How we will do it is a little bit more up for debate.
It's a moonshot to change that. It's a literal moonshot.
It's not even just a moonshot. There's a ton of built-in incentives in the current system that you also have to change, right? And how the processes work. For example, I'll ask, and I know we're streaming, so rhetorical question I'll just throw out to the audience. When has anybody given any credit bureau explicit authority to create a credit score on you?
Can you repeat that last part?
When have you ever given a credit bureau authority or approval to create a credit score on you?
Yeah, never. It's imposed on you.
So we start with the basics. You've never actually given any credit bureau the ability to create a score on you, but it's embedded in a bunch of credit agreements. If you ever took out a student loan, if you ever try to rent an apartment, if you ever try to get a car, if you try to get a cell phone, anything that requires credit, automatically, implicitly in the agreement that you sign to open a new cell phone, it gives them the ability to go run your credit score. And if you don't have one, create one. So just the foundational aspect of this thing is so embedded in all the stuff that we do that you don't even think about. Then another rhetorical question I ask people, how many credit scores do you think you have?
I would say one, but I probably have a couple.
North of 70.
Holy shit. Why? It's like one per bank or one per
bureau.
Are they even unified?
Not really. They're close. So the thing about it is you have one credit score per product. So credit card has a score, mortgage has a score, student loan has a score, your auto loan has a score, your car insurance has a score. There's something called a general obligation score. There's all these different scores. Then you have the 3 bureaus. You have FICO and Vantage, which creates 2 separate models for all those scores, right? And then you have the bigger banks can't use just those scores. So the big banks have to create their own scores on you. And so you end up having all these scores that you've no idea about.
But why don't they even communicate together with simple APIs?
Well, it's proprietary data, right? So
I would just sign partnership with the other bank to make sure that I'm giving them the right loan and not be effed.
In terms of what institutions?
If I would loan money, right? Because I'm asking you these
Mhm.
questions because I'm thinking of eventually starting a fintech that loans money to entrepreneurs that are
Mhm.
completely different creatures than consumers, right? An entrepreneur,
Typical, yeah.
if I loan them like a clear bank, if you want in Canada, if you study that model, an entrepreneur, if you loan them like $2,000 today and they invest it in the right place, and then AI would filter where they would loan that money. Next week they can have 6,000 and give me my 2,000 bucks
Plus, yeah,
plus
plus your
100 interest.
Mhm. Yeah.
So why aren't banks like better linking the data together to
There's a
loan better
bunch of
money and get more money?
Well, there's a bunch of regulatory things around privacy, data privacy, security. Obviously, they just try to link it and somebody hacks into that system and steals your information. Everybody's on the hook, right? So think of Equifax, the bureau in the US that was hacked about like 4 or 5 years ago. Don't quote me on exactly when it was, but that was 160 million people's info exposed, right? And that was just one bureau. So now if you take all the banks and you tell them to do a data lake, which is the only thing that you could do at that level, right, with 300 million-ish, let's say like 170, 180 million people's info swimming around there, that becomes very challenging. Banks can barely keep their own things secure because they're always getting attacked. There's so many cyber attacks against financial institutions because they have all this critical information. And so now you're asking them to share this stuff together in one place. That's just one other place that everybody's going to attack. So it sounds good, but the execution of that would be very, very difficult from a data privacy standpoint and a security standpoint.
And is it blockchain a solution on the bank side of things, but could be a potential solution on the consumer side of things as well?
It could. I eventually want to get, actually, one of my longer term goals is to get the entire mortgage process and market on blockchain. I've started mapping it out already, actually. But you have
Won't quantum break that shit in 10 years from now?
potentially.
But we'll have pivoted before that, I guess,
I
into
mean, but if
something else.
you think about it, from what we have today, with all the paperwork and the inefficient processes and the verification processes, blockchain is light years away. I mean, light years ahead of what we have existing. So if you're just thinking about incremental improvement, and it wouldn't even be incremental, it would be actually pretty substantial. There'd be a substantial change to get the entire, because you're talking trillions of dollars. Just in the US, there's $14 trillion of issued mortgages, plus home equity, right? So it's a huge, huge market.
Right.
To get all those people to do the same thing correctly, to move technology with them, man, these folks they just got off paper.
Yeah, and I'm bullish on crypto to give power back to the people because, in my opinion, banks are just gerontocracies, old investors, old boards, and just doing the same low innovation and mostly built to. It's like a win-loss relationship, right? Like there's not a lot of options. They take data without your consent, quote unquote, or the option to say yes or no, for example. And they're sort of built to avoid bank runs, right? They don't really give us information. They're biased. They're sort of colluding with credit card companies. So just, I think, a new system to give the power back to people. Regarding to my idea to loan out money to entrepreneurs and founders, I'd certainly use AI to also filter that, right? Like feed all their data to an AI, as much data as possible, and ask that brain to give me an answer with like some specific algorithm. Are you using AI on your side with MyHomePathway as well?
Not as yet. We are exploring adding some AI capabilities in terms of risk assessments, and our AI. We want to build an AI advisor to really leverage all the data points for a consumer's profile, and then build them even more, because we provide personalized recommendations now, but even more granular personalized recommendations and real time, and even predicting real time things around people's decisioning around like family planning, savings, how they actually spend, things around like their purchasing power and around that side. So we will eventually put some AI capabilities. We haven't yet, but we want to make sure it's the right thing versus just chasing AI for the sake of AI.
Love it. Where can people find out more about you, Cast?
MyHomePathway.com. So MyHomePathway.com. Appreciate, Charles, the opportunity to share.
My pleasure. So that was Castleigh Johnson and Charles Cormier for another founder